Today, we are going to break down a really specific, rules-based trading setup. It's designed to do one thing and do it incredibly well. Catch the very beginning of a new market trend. It's all about finding a structured way to answer that one crucial question. Is this trend for real, and is now the time to get in? Let's dive in.
It's the classic trader's dilemma, right? You see something that looks like a new trend starting to form. If you jump in too early, you get totally whipsawed on a false start. But if you wait too long for that perfect confirmation, you end up missing the best, most powerful part of the entire move. The strategy we're about to walk through is designed to find that perfect sweet spot.
So, the solution here is to focus on a very specific moment. The first time a brand new emerging trend pulls back and actually proves its strength. This first signal setup, well, it's designed to give you a much higher probability entry right after the trend has shown its initial cards, but way before the big crowd piles in.
Okay, so at its heart, this is a two-time frame approach. It's pretty simple, actually. We're going to use a higher time frame for our confirmation, to make sure the new trend is legit and has some real strength behind it. Then, and only then, are we going to zoom into a lower time frame for the execution, the exact trigger to get into the trade.
So, first things first, we have to look at the big picture. Before we even think about placing a trade, there is a very strict four-part checklist. These are 4 totally non-negotiable conditions that have to be met on our higher time frame chart. Think of this as our filter, our quality control, to make sure we aren't just chasing random market noise.
These 4 rules are our filter. You can think of it like checking 4 boxes. Is the price actually showing strength? Is the short-term momentum holding up? Are we getting in early? And is the directional bias pointing our way? If we can say yes to all 4, then we can move on. So let's break down exactly what each one of these means.
Okay, rule number 1. This is our first clear sign of strength. So after a stock breaks its old pattern, we're watching for its very first pullback. The key here is that the price comes back down to test that 18-period moving average and find support. It refuses to break below. This is basically the market telling us, hey, buyers are now stepping in at these higher prices with confidence.
Rule 2 is all about momentum. Look, price never moves in a straight line, right? So while the price itself is taking a little breather and pulling back, we need to confirm that the underlying force of the trend is still strong. On our MACD indicator, as long as that main MACD line stays above its slower signal line, that tells us the upward force is still in control. If it breaks below, that's a red flag. The setup is immediately invalid.
Now, our third rule is all about timing. We want to be early, that's the whole point. This condition makes sure we are only looking at the very first pullback, or pinch as it's called, in the MACD indicator, right as it's shifting from negative to positive territory near that zero line. The source material is crystal clear on this. The first signal is the most reliable one. Sure, later signals might work, but they carry a lot more risk as the trend gets older.
And our final check is the directional index. This is just a simple way to measure buying pressure versus selling pressure. For our setup to be valid, we need to see the buying pressure, that's the positive DI line, holding firmly above the selling pressure. This just confirms the bulls are still in charge, even during this small dip. And here's a key point. The overall ADX, the trend strength indicator, it might still be low, and that's totally fine. Remember, we're trying to catch the trend as it's just beginning.
All right, so once all 4 of our big picture rules are met, and I mean only when they're all met, we finally have our confirmation. Now, we shift gears from analysis to action. We zoom into our lower time frame chart to hunt for that exact mechanical entry trigger.
And this slide really nails the whole idea behind the 2-time frame approach. The higher time frame, say a weekly chart, it answers the big important question, is this new trend for real? And the lower time frame, like a daily chart, answers the immediate question, is it time to act right now? Using them together gives us both conviction and precision.
Now, the entry trigger is a very specific, almost robotic 3-step sequence. Step 1, we wait for a deep pullback, and we see that when the faster 18 moving average crosses below the slower 40. Step 2, we need to see the price itself follow along and actually close below both of those lines. This proves the pullback is for real. And finally, step 3 is our signal. We enter only when the price shows new strength by closing back above that 40 moving average. That is the exact moment the trend is telling us it's ready to go again.
And this right here, this is the real aha moment of the whole setup. This quote really captures the magic. The fact that the lower time frame can go through this entire deep pullback sequence, while the big picture momentum on the higher time frame stays strong, that is an incredibly powerful sign. It tells you the underlying upward pressure is so massive that it can easily absorb all this selling and is just ready to take off again.
So we get it. Now what's the plan? This isn't some long-term set it and forget it kind of system. It's a very precise swing trade with a clear goal, to catch one single powerful leg of the new trend. So let's look at the game plan.
So here it is, the whole game plan on one slide. The goal, catch one powerful leg up. The entry, that close above the 40 MA we just talked about. And the risk management is beautifully simple. Both our stop loss and our profit target are based on the average true range, or ATR, which is just a simple indicator that measures a stock's recent volatility.
And this is the most elegant part of the whole plan. It's so simple. Your stop loss is placed at 2 times the ATR value below your entry price, and your profit target is set at 2 times the ATR value above your entry price. It's a symmetrical one-to-one risk/reward trade. It's designed for a quick, high-probability move. You get in, you catch the leg, and you get out. Simple.
Okay, let's wrap all this up and just crystallize the most important rules and the context around them. Getting this part right is absolutely crucial if you want to apply this strategy effectively.
Remember these 4 key things. First, this is a fractal pattern. It can work on any adjacent timeframes, from a weekly/daily combo all the way down to a 5-minute/1 minute chart. Second, and this is so important, the very first signal you see in a new trend is always the strongest and most reliable. Third, this isn't just for bull markets. You can invert all these rules to catch new downtrends too. And finally, always remember the goal. This is a precise swing trade to capture one move, not a system to ride an entire trend for months.
So, with this clear, rules-based framework, you now have a powerful new tool for identifying the earliest, confirmed start of a new trend. The only question left is, where are you going to spot the next one?